This is episode 7 of the Trading Bootcamp. I'm going to be going over internal and external ranges and also ranges in general in the market. So what is a range in the market and how can we use them to actually, enter trades and target opposing sides of the range? Now let's get straight on with it and break down what a range is. So here I'm drawing out two sets of market structure that we should be able to identify now. And the way you can identify your internal and external is just think of it as what the words are saying. So these two lows here are both internal lows. And the reason that they're internal lows is because it's inside of a larger move. What I mean by a larger move is this is the full move up. Okay, this is clearly a bullish uptrend. We're going up in the market. So all of these internal lows have got liquidity resting below. So there's liquidity below this low. There's liquidity below this low. Basic liquidity pools. These are just small liquidity pools that the market may sweep and then continue in the uptrend. The difference between an internal and external is that once an external high or low gets swept, that is my favourite type of liquidity sweep to then look for a large scale reversal. So these two that I've just marked out would be examples of external highs and lows. Now remember, anything that's inside a move is internal. Anything on the outside of the move is external. That's the simplest way of putting it. So there's your internal lows and there's your external lows as well. Of course, in a downtrend, you've got your internal highs. So these two here, and also this one, is an internal high. So all these three are internal highs. Of course, your external would be where the market actually started reversing. So let's say this was the uptrend that we were in, and then suddenly the market started doing this. Okay, and now we flipped to being bearish. So here would be your external level that matches up with this. Okay, let's say the market was like that. It makes a lot more sense now, okay? If I get rid of all this, you can see that you've got an internal high, an internal high, an internal high. And what are we doing? We are taking out internal lows as we go further down in the market. And that is how the market moves. So we know above every single internal high and internal low is liquidity. Now, what I'm trying to get at here is the way you can use these to your advantage and the way you can kind of understand is once we have an external high swept, that is when I personally expect to see a trade setup. So I'm going to pull price back to this scenario here. Okay, so on the 1 minute time frame is what I usually trade on. And you'll see we have got an external high. Okay, pretty obvious. You should be able to just notice that straight away. There's no other high or anything to the left. So this is the external high. This here would be your external low. The reason being is because this is where the move started to the upside. This is where the market flipped and we flipped bullish. So this here would be your external low. And of course, like I've just stated in the previous example, these both would be internal lows. So now that that's out of the way, I personally look for reversals at major external highs and lows. So once one of these gets swept, I then instantly think, okay, I flip back onto my checklist, which is in the inversion fair value gap video, which I've just uploaded, and I would look at my checklist and see it, have we got those three major points? If you haven't yet seen that video, then make sure you go and watch episode 6, and then come back to this video. It'll make a lot more sense. So that's when I would flick to my checklist and see, have we got the clear and obvious gap? Have we got a clear draw on liquidity, etc. And you'll see when we come up, we sweep this external high, so this now becomes a liquidity sweep. And I start looking for any clear and obvious gaps. And you'll see we start pushing lower here. So this is already giving signs of a reversal, okay? We've instantly swept the high, we haven't really displaced above it, and we've already started coming down. So this is further adding confirmation in real time that we may come lower here. We then sweep that high again. And this is now where I'm on other time frames. I'm looking, is there any clear and obvious gaps? So you'll see on the 2 minute that we have got this gap that we have already bounced off and respected. We've got this 2 minute gap that is pretty clear and obvious. It's not the most obvious fair value gap, but it is obvious. It's not like in your face where you just notice it, but it is clear and obvious. you know, and the next fair value gap we've got is down here. So there's plenty of room to target if you did enter short. You can see we've already tapped in and we've bounced out. So again, I'll just be patient and I'll wait for a clear and obvious gap to form. And we don't get one, okay? What actually happens is we come straight down and we start displacing lower. We actually form a small inversion fair value up there, which isn't the most clear or obvious, so I would still prefer to use this one. Now at this point now, this was happening in real time. I said to everyone on the stream, we're probably going to come lower, you know. The reason being is if we look to the left, this is what you always have to do. Once you sweep an external high, you know, I would look to the left and see, is there anything else that's close by that we should sweep before reversing? This is one of the major things that I try and teach to my students is, when I enter a trade or when I see a setup forming, I ask myself, does it make sense for the market to do what I want it to do? And that obviously sounds so generic, but you've got to understand what I mean when I say that. Like, it's all right saying, oh, I want the market reverse here, we've swept the major low, but does it actually make sense for the market to sweep that low and then completely reverse? Like, is there anything to the left that we should be sweeping? So, for example, let's say price came up to this point here, okay, and then started reversing like this. I would not be interested in a short unless it was like, you know what, I wouldn't even be interested in it at all. Like, there's no ifs or buts about that. I just wouldn't be interested. Because I wouldn't see the point, and I wouldn't see how it's possible for the market to reverse without taking this high. Okay, this external high, which is so clear and obvious, and there's so much liquidity above it. Why would we not take that and then start dropping? Do you know what I mean? It's got to make sense. But of course, we didn't in this scenario. Okay, there's nothing to the left, so it did make sense to come down. We just took a major external high. We haven't really displaced above it. So this was pretty valid. And then I was looking at targets. So this is where we go onto the checklist and we check, have we got any clear and obvious targets? Now, in this example right now, there isn't actually many clear or obvious targets in terms of equal lows or anything like that. But what we did have was good displacement down and a clear sign of reversal. Not only that, but we were also extremely high in premium. So you can see that we are so far up currently, and we haven't really had any major pullback from this large move. So even then, in the worst case, we could expect us to come back into discount, which also coincidentally ties up with the next fair value gap in the move. So all this is happening at the same time in real time, and you've just got to analyze this as it's happening. So this is now where the next candle plays out. We tap back in, and this candle here, is the one where I actually entered a short. I did enter a bit late, I will admit, but I did eventually catch the move. And this is now where I would expect to take a short position. My stop loss would be a candle close back above as normal. And you can simply target the next swing point, or you can target the other external side of the range. Now, this strategy can be used in so many different ways. Like, it's also called the Asian sweep, the London sweep, you know, the New York sweep. Like, when a session gets swept or an external high or low gets swept, you can always expect the reversal. And when it shows it to you so clear and obvious, where we displace down with no bullish candles, we start smashing through fair value gaps, it kind of already just tells you, like, it should just slap you in the face and say, we are coming lower, or we are going to reverse. So I'll play it out and you'll see we do get a bit choppy, but then eventually we just smash straight down to the external low. And look how accurate that is. Look how accurate the TP is. Straight to the external low. Okay, so I'm going to pull price back to this scenario here. Now, you can see that we are already, dropping. We've already dropped quite a lot. And this is an example where you can use an internal liquidity sweep to enter a trade. So I've just shown you an external. That's where you get a large scale reversal when you sweep a major high, like up here. Obviously, an internal move is going to be a bit smaller, but they happen a lot more frequently because, of course, we're always taking out internal highs and lows, and that's how the market moves. So in this scenario now, you can clearly see the market structure. We've got low, high, lower low, lower high, lower low, lower high. So we are expecting now another pullback at least to then continue down. That's what you should be expecting. And you'll see when I play through, we actually come up and take out this internal high. So we've got another internal high there, another internal high there. You get the point, okay? So we come up, and this is where we're creating that lower high. And this one we actually sweep. So in this scenario now, this is where, again, if you see any clear and obvious fair value gaps, they could be potentially a point of entry. And you'll see when I play through, we sweep the high and we inverse this clear and obvious gap on the 2 minute time frame. Look how clear and obvious that gap is, okay? You know, we have not displaced above the high at all. We've perfectly wicked above it. So it's literally just a liquidity sweep. And we've instantly displaced down. Look at the size of the candle. Look at the momentum. And we're also bearish. Okay, we're already in a downward move. So this is an internal move, okay? Because you're not waiting for an external high to be swept. All you're doing is waiting for an internal liquidity sweep, a clear and obvious gap to form that gets disrespected. So this is now where we'd enter a short position. Stop loss, candle close back above. And this is where now you can look to the left. And is there any clear and obvious targets? So, firstly, we have got this clear and obvious wick, okay? That just standing there in the market, you know, not been swept yet. And then lastly, you should be identifying this, okay? This is an external level of liquidity because this pumps up the market and creates this large bullish move all the way up, okay? This low is the external low of all of this, okay? So this is a major low in the market. So we know, again, there's a lot of money resting down here. Now, this is how you compile your trade together. And when you'll see when we play it through, the first TP gets hit straight away. And there you will probably go to break even. And there we hit break even. But you can see that is how you can form a trade. So you literally wait for an internal high or low to be swept. Is there any clear and obvious gaps? And if there is, wait for it to be displaced through and then target a good liquidity pool. And that is literally the three-step model that I use every single day. External highs / lows equals potential large reversal. And for an internal highs / lows is a continuation of trend. Okay, once we see an external high or low get swept, that is indicating a sign of a potentially large reversal. When an internal high gets swept or a low, that is just a continuation of trend. So that's where we look for the overall trend to continue. And that is exactly what we did right here. Okay, we waited for an internal high to be swept, which it did. And all we did then was look for a continuation model of the overall trend, which is clearly bearish, and we got on a short, and we targeted the next level. And that is genuinely how simple it is to find these trades. Like, all it's about is being patient, waiting for the highs to be swept, and waiting for clear and obvious gaps. I'm not interested in any move until one of these key levels gets swept. If there's a little inversion here, then I'm not interested in it. I've got to see a liquidity sweep. That is the major thing. You'll see we come up and we sweep out this external high. Okay, so this is now where I look on different time frames. Have we got any clear and obvious gaps? We've got a 4 minute, okay? So far, we've got a clear and obvious 4 minute. That stands out to you and it should instantly slap you in the face. It's the only obvious gap on the screen, bar this one. Okay, that we actually respected. So this is the most recent large clear and obvious gap. So now that we know we've swept an external high, we look left. Is there anything else? No. Okay, so does it make sense to come down? Yes, it does. So again, all we do now is simply be patient and wait for this clear and obvious gap to be disrespected with displacement. And you'll see, there we go. Now, again, if this doesn't like just give you a light bulb moment, then I don't think this strategy is for you because it's so clear and obvious to me. I just don't understand why a lot more people don't use this strategy because it's genuinely unbelievable. Like, look how obvious that looks. Like, if you showed that to a beginner and said, where do you think it's going to go? Based off these last 5 candles, it's so obvious to me. Like, I don't know if it's just me because I know the model. To me, like, come on, that is so obvious that we're going to dump and we're just going to displace down now. So again, we enter a short position. Your first target can be this internal liquidity. You could close a partial, go break even here if you wanted to. And we simply just target the external liquidity again, which started the original move. And you'll see when I play through, look at that, within 2 candles. Like, it's honestly, you might think this is just because I'm on replay mode, I've picked the best examples. This is definitely not the best example, but it just works, okay? It just works, and that's all I can tell you. So yeah, that's it for today's episode. Hopefully you enjoyed it. If you did enjoy the video, please like the video, subscribe to my channel so you don't miss any more of these videos, and also don't forget to join the free trading Discord in the description below. And I'll see you on the next one.